Welcome to the 3 Edge Week in Review for the week of May 12th. I'm Fritz Folts, Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, the CEO and Chief Investment Officer here at 3 Edge Asset Management. The S&P 500 has now gained back all of the losses that occurred following the Liberation Day announcement of sweeping tariffs on U.S. trading partners, and now it's hovering right around break even, although it remains below the highs reached in mid-February of this year. And so today, Steve and I are going to discuss whether can we consider that the coast is clear for the equity markets and we can continue to rally from here, or are we just experiencing a temporary buy-the-dip relief rally as a result of the Trump administration pausing its proposed reciprocal tariffs and the recent partial 3-month tariff ceasefire between the U.S. and China? And we'll seek to lay out the arguments for both the potential positive as well as potentially negative scenarios, and discuss how investors might position their portfolios to be prepared for the uncertainty that may lie ahead. So let me bring Steve into the conversation here. Steve, as I mentioned earlier, the S&P has clawed its way back now following the tariff announcement on April 2nd. And so investors are wondering, is it all clear now? Can equities continue to rally from here, or is there another shoe or shoes still to drop, which could send the markets back down? So maybe you could lay out, to start, the positive scenario. Like what would that look like where the worst is behind us at this point?
Well, Fritz, the optimists certainly hope that this is all clear signal that we received, and there have been a number of positives. We've been through earnings season, and we've seen very strong Q1, first quarter corporate earnings, no question about that. We still have stable employment. The last employment report was very stable. The last inflation report was good. We've had inflation continue to come down close to that 2% number, or closer, I should say. And as you mentioned, the latest tariff news was a de-escalation, not a re-escalation. And clearly, with this big rebound, when the market fell 20%, remember, if you fall 20%, you have to rise 25% just to get back to break even. Well, that's what happened. We fell 20%. Now we've gone back up 25%, which is a huge move in both directions. Lots of volatility. But it's been the retail investors that are largely behind that big rebound that we had. And so what that means is that the buy-the-dip mentality that existed for many months and a few years is still intact. So these are all positive signs. And the hope is that now the momentum will continue, more people will jump back on the bandwagon, and we're all clear.
All right. So now let's look at the potentially less positive scenario and how that could play out in the weeks and months ahead, where this rally is only temporary and we get another pullback. What might that look like?
So I want to draw an analogy that many people may have experienced, and that has to do with hurricanes. And if you recall how a hurricane develops, there's a big low pressure system in the center of the hurricane, and the wind whips around on a counterclockwise basis around that low. And when the hurricane system comes toward you, you start to get that tremendous wind that can be very destructive. And there's a lot of chaos, a lot of damage, and so on. Then all of a sudden, everything gets calm. There's no more wind. In some cases, the sun comes out, the clouds break, and it seems like the hurricane has moved on. We're all clear. But what really is the case is that you're in the eye of the hurricane, in that center part where the wind is whipping around that eye, but right in the eye, it's very calm. And you have this false sense that it's all clear. You can go back outside. Many people do. But it's just a matter of time before the hurricane system continues to move on. And now you're on the backside of the hurricane, which is sometimes even more destructive than the front. And I draw that analogy because we're in a very unusual period here where, as I mentioned, all the hard data has been very positive. We've got stable inflation. We've got stable employment. We've had good corporate earnings. Everything looks great. The market's back in a rally mode. But we could be in that eye of the hurricane because a lot of the chaos that's been created in corporate planning, in setting prices, in making purchase decisions, etc., haven't hit the hard data yet. And it might take another month or two before we start to see that show up in the economic data. And when it does, we could have a very different picture. We could find that we get supply chain disruptions. And remember, even though we've seen a bit of a truce between US and China and a big reduction in the original proposed tariffs, we are still sitting at the highest tariff rates since the 1930s. There's still been a big increase, even with this back down. So there's still trouble to be had with the tariffs that are still remaining. We could have supply chain disruptions that could cause inflation to rebound, that could cause higher long-term interest rates, which won't be friendly to the market or to consumers trying to borrow to buy things. We could see an economic slowdown. As companies get nervous, they could not only stop hiring, but start adding to the unemployment rolls. And the worst case of all, if we have rising inflation at the same time the economy is slowing down, that's stagflation. And that's exactly what happened in the 1970s after President Nixon raised tariffs just 10%. I say just, that's a big increase, but compared to some of the discussions we've had, 10% seems like it's fine, but it's still problematic. We just saw this week Walmart announcing that they're going to have to raise their prices just with the tariffs that are already in place right now. So that is the what if we're in the eye of the hurricane scenario.
Excellent. And also, in our industry, even, no one's seen stagflation for so long. People in our industry, a lot of them just haven't experienced it. So maybe that's why it's not getting quite as much attention. But my final question is, okay, if we have to keep both of these scenarios in mind as we construct a portfolio, what might investors think about doing with their portfolio to sort of be ready for either scenario to come?
Well, the honest answer, Fritz, is that the market direction over the next few days or weeks depends a lot on whatever policy moves come out of the major players like our administration, other governments, Federal Reserve Board, other central banks, et cetera, moves that haven't happened yet. So there's going to still be a period of radical uncertainty. And as you were alluding to, we think with this uncertainty, it would be a big mistake to be overly confident and put all the marbles on the all clear scenario. And we also think it'd be a mistake to put all the marbles in the eye of the hurricane scenario because there is some possibility of either scenarios playing out. So we think this is, if there's ever a time to be diversified, this is the perfect time to be diversified. We don't think you should be at your maximum allocation for equities. If you have a range, we don't think you should be at your minimum allocation. We think you should be, somewhere in the middle, maybe a little bit more cautious. It shouldn't be all in one country like the US. It should be more diversified. As we've seen, international stocks have finally started to outperform US stocks for the first time in many years. And there are reasons for that because they're not as overvalued, so there might be more upside and less downside. But it's also important, you mentioned stagflation and how that's not getting a lot of attention, but it's also important that whatever hedges are in place beyond the equity allocation should protect an investor from stagflation. And stocks don't protect you from stagflation. Longer-term bonds don't protect you from stagflation. But gold, Treasury inflation-protected securities, and short-term U.S. Treasury bills do protect you from stagflation. So we want to make sure we have a healthy allocation to those.
Yeah, and one of the advantages of being a multi-asset investor in this case. So that's great. So thanks, Steve. One thing seems certain, and that is that increased uncertainty will most likely remain the market's full-time companion in the months ahead. So that will do it for Steve and me for this week. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you know someone who might benefit from these videos, please feel free to share them. And if you enjoy our videos, please feel free to subscribe to our YouTube channel. We would be very appreciative if you were to do so. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.